We'll get started in a minute. My name's Darcy. I work here at Equity Mates. Welcome to the Aweno trading floor. Massive thanks to Aweno for being a major sponsor of FinFest. Hope it's been a good day so far. This is our last session here in the Aweno trading floor. And this is a great session. We've got Dania Zinurova. So if you're looking for a hedge against the current inflationary environment and want to know more about opportunities in private equity, water rights, real estate and other assets, this is a great session for you. Dania Zinurova is the portfolio manager at Wilson Asset Management, and she'll discuss the strong case for investing in alternative assets for downside protection in today's market. Quick disclaimer, all the information presented today is for education and entertainment purposes only. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. If you're unsure, please speak to a financial professional. Equity Mates Media operates under AFSL licence 540697. Please welcome Dania.
Thank you. I have the mic. This is officially the best event I've ever attended in the financial industry. Honestly, this is amazing. It's a breakthrough what Equity Mates are doing. I loved the first line of the disclaimer that this is only for educational and entertainment purposes. So I really hope my presentation will be entertaining and also educational. I manage a portfolio that is listed on ASX. It's structured in a very unique form as listed investment company, but at the same time invests in unlisted assets. All assets that we have in the portfolio, they are categorized as alternative unlisted assets. Before I start talking about the portfolio that I manage, I just wanted to take a step back and talk about Wilson Asset Management. Incredible organization with over 20 years of experience. I don't know if any of you have heard about Jeff Wilson. He's been advocate for retail shareholders for decades, including the most recent franking campaign, and they've been delivering solid returns to the Australian investors. Now, the difference from many other fund managers that you find in the Australian market is that Wilson Asset Management is predominantly focusing on listed investment companies. So listed investment company is really about closed-end, perpetual pool of capital, so that a portfolio manager who is looking after your investments, after the capital that you committed, they are not under the pressure when the market experiences high volatility. They can still pursue their strategy and deliver the investment returns. In other words, they don't face, like many other structures, constant contributions or redemptions from their portfolios. Our shareholders, and we have about 150,000 shareholders now in Australia, they really like stable, fully franked dividend streams from listed investment companies. So this is one of the main features for LIC. When you think about your future, when you think about your investments, you do need to think about income return, and LIC is one of the structures that can provide fairly stable, fully franked dividends over long periods of time. At Wilson Asset Management, we predominantly focus on equities, and Alternative Assets Fund that I manage is the first portfolio that we decided to do within alternative asset classes. One of the really standout features of Wilson Asset Management that we launched several years ago, Future Generation platform. It's an incredible platform where we have Australian equities and global equity strategies. All service providers, fund managers, accountants, audit, tax, legal, they're all done pro bono, so they don't charge any fees. And then 1% of the revenues is donated to charities that we select based on two criteria. One, youth mental health, and the second one, youth at risk. And since inception, from my memory, we donated about $65 million. So quite an incredible organization in terms of the strong purpose. Now let's go to alternatives. If you want to know a bit more about the portfolio that I manage, as I mentioned, it's listed on ASX under the ticker WMA. You can find annual reports, monthly and year reports, all on ASX website, and numerous education videos, articles on alternatives that we've been producing over years. As I mentioned, when you think about LEAK, think about dividend growth, capital appreciation over time, think about diversification benefits in terms of the alternative assets. When we think about alternative assets and think about investment strategies or investment opportunities to select in the portfolio, our starting point is always about identifying the megatrends and identifying the megatrends with long, very strong tailwinds. And I'll give you the examples, the ones that we follow within the portfolio. One is climate change, another one is digitalization, third one is growing aging population, and finally growing demand for food. To give you an example, within climate change, there can be opportunities across asset classes. We can find opportunities in this trend or supported by this trend in real estate, in infrastructure, in private equity, in real assets. In infrastructure, for example, it could be an investment in renewable energy asset, solar energy or wind farm. In private equity, we have an example within our portfolio. We invested in a company called Climate Friendly. That is one of the oldest businesses in Australia that generates and identifies opportunities for carbon credits. The returns from those investments are really strong, and the importance of identifying those long-term trends is really high because we are talking about illiquid asset classes. In other words, when we make investment decisions and we commit the capital, we are making commitment for 5, 7, sometimes 10 years, and sometimes even longer than 10 years. So let's talk about alternative assets. I'm sure you've had a lot of information today, lots of asset classes to discuss and to consider. When I talk about alternative assets, I talk predominantly about assets that are tangible. And due to their specific tangible characteristics, we can derive their value and we can make investment decisions. We invest in assets within real estate, private equity, that also includes venture capital, infrastructure, real assets. Real assets can include agriculture, timberland, fishing rights, water rights. It's a very broad universe on its own. And then the most recent addition to the portfolio was private debt. So, just visualize this and remember, we don't include cryptocurrency or hedge funds. These are tangible assets. In terms of the benefits, why investing in alternative asset classes, there are a number of benefits. One that I'm sure most of you have heard about or have studied about is diversification benefits. What does it mean? It means that if you invest in water rights or fishing rights, it's very unlikely your investment returns will be correlated to equities or fixed income. In other words, to more traditional asset classes. They're likely to have very low correlation or negative correlation to those traditional asset classes. So if you think about your investment portfolios and your future financial goals, think about constructing the portfolio in a way that has a really good level of diversification and downside protection, because many of our shareholders, they have been historically investing in equities. Equities has delivered amazing returns over decades in Australia. In fact, we haven't really experienced the crisis like we're experiencing now for over 2 decades. Now is the period, now is the phase when we are getting a lot of questions from our shareholders. Where do I find opportunities to find this downside protection, to find inflation hedge, to find interest rate hedge? And I give you examples. Diversification is an overlaying principle when you think about alternative assets. But then when we think about the current environment, we're also living in a very unique environment for our generations. It's a highly inflationary environment. Asset classes like real estate and infrastructure, they have natural embedded inflation hedge. In other words, think about a real estate asset where a tenant is Ramsey Hospital. Now, this would be a very different real estate asset versus Westfield shopping center that you go in Pitt Street. The difference would be in the length of lease agreement on this type of assets. The lease agreement usually for this type of assets would be 10 years or even longer. On top of that, rents will be CPI linked. So one of the investments in our portfolio is investment in healthcare real estate, where 70% of income is CPI linked. Very similar story about infrastructure investments. Many infrastructure assets, they deliver yield that is predominantly CPI linked due to their very unique nature of contract structures. Another point that I mentioned briefly is interest rate hedge. Again, very interesting environment that we haven't really experienced for a long time, where central banks around the world, they're increasing interest rates in order to control the inflation, albeit that's a separate question whether they can do it. What we are facing now, that borrowing costs are increasing, but for you as investors, it means an investment opportunity. What we did, we invested in private debt, very simple strategy, senior loan fund, basically lending to well-established, matured, cash-generative businesses. Most of the time, 99%, the deals are floating rates, which means that as RBA increases the interest rate, our yield increases at the same rate. So these are the opportunities that you literally can find predominantly in alternative asset classes. All very important factors to think of when you consider your future financial goals, when you think about your investment portfolios. There are other things here, and one that is often overlooked is opportunity to deliver excess returns. I can give you an example on private equity. It's a fact. There is a lot of data supporting this fact. Private equity delivers, on average, 5% excess return over listed equities over long term. And that's been the case over all economic cycles, over all inflationary environments and various interest rate environments. So really important point, again, from our generational point of view, we don't think just about income or yield. We also think about future growth. So what are other asset classes that can deliver you this growth? Private equity is one of them, and obviously there are others within alternatives. This is a really good example to illustrate the point that I also wanted to make about alternatives, is that alternative asset classes and investment returns from those asset classes, they don't experience the same level of volatility as equity markets. So hopefully sometimes in the morning you wake up, you check AFR or you check Bloomberg, and you see share prices are just changing in an hourly fashion, for sure in a daily fashion. This doesn't happen in alternative asset classes. The reason is very simple, because the valuations are done predominantly based on the business performance, underlying assets or underlying business performance. And I just wanted to illustrate it. We do have Temple & Webster in one of our equity portfolios. And we plotted on this chart revenue growth of the business and then share price from the time it was listed. It was listed in December 2015. As you will see, the revenue growth is very consistent. The business went through a number of mergers just prior to IPO, so there was an expectation that the business will continue growing, the revenue will grow, the EBITDA and margins will continue growing. Now, have a look what's happening to the share price since it went through IPOs. Have a look at the volatility that this stock experiences, because the share price is affected not only by the actual business fundamentals or the performance of the business. It's affected by central bank announcements. It's affected by market sentiment. It's affected by the announcement from the management teams. In other words, the factors that are extremely hard to control and manage within the portfolio. So that's hopefully gives you a bit more visual example on why when we talk about alternatives, we talk about low volatility. How do we value alternative assets? To give you an example, our investments in private equity, infrastructure, real estate, they're generally valued on a 6-monthly basis or on the annual basis. They are done in accordance to international accounting standards. It's a very transparent process, and they are done by independent valuers. So often I see in AFR and other media in particular now that it's a murky space. You don't understand how the values are done in private markets. I would hugely disagree because it's a very clear and transparent process. In fact, it's more clear compared to how some of the stocks are valued by the market. This is just to show you what's inside our portfolio. So as I mentioned, lots of asset classes in the portfolio. We invest direct, we invest in pooled funds, we invest through separate mandates. There are different implementation routes in the portfolio. And you will see that some of the investments, they are new commitments. Let's say we committed more recently to a private equity strategy managed by Allegro. It's a turnaround transformation private equity manager in Australia. What happens when you invest in private equity is that your capital, your investment is not deployed immediately. It's a very patient process. As the investment team identifies investment opportunity, they start calling capital from you. But the reality is it can take 12 to 18 to 24 months before the capital is deployed. So please don't rush when you make investment decisions in alternative asset classes. It does take time, but it also pays off over long term. Just some examples of our newer holdings and one of the larger holdings. Water Fund is probably the one that attracts a lot of attention from our shareholders because like the ones who are here, who live here in Sydney or are from Sydney, everyone has been experiencing La Nina. I'm sure everyone is familiar with this. Everyone knows that we are living in this very strange period. It's third year in a row of really high rainfall. So what water rights is basically, I'll try to explain it without going into the details, albeit it's a really interesting area. And it's a great diversification within the portfolio. But basically, as an investor, you would buy entitlements, water entitlements, that you can then lease to irrigators, to farmers. So let's say farmers who grow annual crops like wheat, they rely a lot on seasonal rains. They haven't been really buyers of water entitlements because we had so much rain over the last 3 years. But farmers who grow permanent crops like almonds, macadamia trees, they need water throughout the year. So most of the time they are the ones who would go and lease these water entitlements because they are very expensive. Australia is one of the most sophisticated markets in the world when it comes to water rights, way ahead the US or European market. So it's a very well developed and liquid market that has both institutional, retail, and wholesale players. And we invest with a manager that constructed for us a very well diversified portfolio. There are about 150 water sources in Australia, and it's really important to look across geographies to ensure the portfolio is structured well across various geographical and climate zones, but also has different irrigators within the portfolio. So we don't just rely on annual crop growers or permanent crop growers. In other words, why do you want to have this asset class within your portfolio? And we have about 30% invested in water rights because on the one hand, the value of water entitlements has been growing over the last decade. In fact, when we look at the current value, it's at the historically high level. So you think about capital appreciation. This asset class can also deliver really good yield. However, this yield will be highly correlated to weather conditions. When we are in the period of drought, the yield is supposed to be really high. When we are in the period of increased rainfall, the yield is supposed to be decreasing. So you think about, I feel like we all need to stand out and move. So you think about this asset class as something that really brings a lot of benefits to any investment portfolio. And I wouldn't advocate invest all your savings in water rights, but really would want to learn more and look at more details. Okay. Private equity, infrastructure. So within infrastructure, we really like renewable energy. We like social infrastructure. We do have exposure to GDP infrastructure, but we've all seen throughout COVID and lockdown that GDP correlated infrastructure or economic infrastructure. Sorry about that, guys. So again, in the current environment, think about investments. If you think about infrastructure, think about the sectors and investments, assets that are less correlated to GDP, that have potential inflation hedge due to their contract structures, and have long-term contracts in place. So for example, with infrastructure, when I look at our exposure within the portfolio, I have visibility on yield over the next 10 years. Because the contracts that we have in place, they're 20, 25 years and plus. In private equity, this was a really interesting investments that we've made with a fund manager called Adamantium. Buyout. So that's like within private equity, I can talk for hours. There are a number of different strategies. Buyout is a really interesting one because you're buying controlling stake in businesses that potentially have some succession planning issues. So let's say it was owned by a family. The family doesn't have any succession plan in place. They do need an experienced investor coming in to continue growing the business and manage it going forward. So we invested with them a very interesting investments that they've made. One of the first ones was that I mentioned climate friendly. To illustrate to you, it's not just about ESG, environment, social, and governance type of investing. It's also about investment returns. Within climate friendly, they had an interest from an offshore buyer this year who wanted to buy a minority stake in the business. The return from this minority stake exit was over 5 times equity multiple. Incredible return. So honestly, these strategies within climate change trend, they will continue delivering very strong investment returns. This is a bit more a page about our effort to really help our shareholders learn more about alternative investing. We are doing a lot with media. We are doing a lot ourselves with our investment partners. So please do check out our website, check out the reports for WMA, and reach out to us with any questions. Thank you.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.